I mean, it's possible they could have potentially sold them. I mean, they could have like loaned them out instead of had to sell them and realize that loss. Their particular case, though, they had such significant unrealized losses relative to their capital, um, that they're kind of an outlier case. Um, so I do think this facility prevents other banks from having a similar issue. I'm not sure it would have been, enough to help there. I think that that question will largely depend on how long rates stay at these levels. Because if you have that significant of unrealized losses relative to your capital for a prolonged period of time, and you start relying on those facilities, then your funding costs start going up, and so that starts to present a significant profitability problem. So it certainly could have helped them in the near term, but it still would have raised questions about their long-term viability, given that they made such a big bet on duration. Well, I think partially it's going to come down to being more conservative with lending, as well as things like dividends and share buybacks, because you want to have plenty of capital on hand to withstand any sort of liquidity shocks or unrealized losses relative to your capital. I think in some ways it could be a profitability sink for a period of time. The large banks, basically, if you think of the deposit base as like a bunch of cups of water, it's really hard to pull all that water out, right? I mean, there's only so many places it can go into. And so it's not like deposits can all just flow out of, say, JP Morgan, Bank of America, and just flow out of the whole system and crush all the system. Instead, it's like, some deposits can leak out into things like money markets and treasuries. But most of the deposits are kind of sticky, and they can shift around, and so for any smaller bank is vulnerable. But those like big four banks that each one is a pretty significant percentage of total deposits, it's really hard for that scale of deposit to flow out unless that bank had such a severe problem that it was extremely warranted. So I don't really view the big four banks, including Bank of America, as a solvency risk here. We also, I don't know Bank of America's full hedging position. I would imagine that they hedge some of that duration risk better than Silicon Valley Bank. But even if they didn't, their losses are smaller than their total capital. So it's not as severe as Silicon Valley Bank. Plus, they have just a way less skittish depositor base, because of one, their size, and two, the types of clients that they accept. And so I do think we'll see generally more conservative behavior among banks going forward. But again, it wasn't, this wasn't really caused by bad bank lending decisions. The risk that somebody's made was a bet on duration, which is in a more understandable risk, I think. I think there could be more out there in the smaller bank land, because a lot of those don't have significant security books. They have a lot of illiquid loans, and they might be high quality loans. I think a lot of them are high quality loans. But if they face a bank run for any reason, they could run into severe liquidity problems, and they can't really use that facility, and so they could either fold, or they could rely on high cost funding to get them through that. And so I think both the profitability and the liquidity of some of the smaller banks are going to be challenged for a while. It also largely comes down to a decision by the Fed. To what extent, now they have a clear trade-off between raising rates versus keeping the banking system somewhat stable. The higher or the longer that they hold rates here, the more it kind of drags deposit rates up to their current level of interest. And that's fine for the big banks, because one is everybody wants an account there, so they're less quick to raise their rates. Whereas like the smaller banks, if they have to raise their deposit rates, then this liquidity problem starts becoming a profitability problem. And if a profitability problem gets bad enough, it can become a solvency problem, right? I mean, if basically liabilities start paying higher rates than assets, and if that's going to persist for a while, then the bank's in trouble. The ironic thing is we actually see that among central banks. They're just lucky because they can't have bank runs, and can't go bankrupt. So the Federal Reserve right now, for example, their liability side, they made the decision to raise those rates significantly, whereas they're actually holding long duration assets. They're holding treasuries and mortgage-backed securities. So I mean, I think the overall unrealized Fed losses were like something like $1 trillion at the peak. Probably now it's hundreds and hundreds of billions, whereas even their operating profit has turned into an operating loss because and that kind of shows what happens if you actually do raise your deposit rate super high while you're holding um, you know, uh, low yielding assets, right? So that's obviously a severe case because most deposit rates won't go up that quickly relative to what the Fed's liability side did. But that's kind of an example of what can happen if deposit rates keep grinding up at a quick rate. I wouldn't be surprised if they hold uh, flat this month, or if they go 25. I'd be surprised if they go any above that. I think it'll partially depend on what happens the next couple days. I mean, we're watching Europe have significant problems now, so some of this is contagious. Um, as for betting a year in the future, I mean, at that point, you're betting on human decisions. So in some ways, you're looking at numbers, but you're also betting on human decisions relative to those numbers. Um, so I think a general framework investors have to have is that this decade, it's going to be very hard to have positive real rates and any sort of normalized persistent basis. There might be brief periods of time, especially in recessions, where you get to positive real rates. But the idea that we're just going to go back to like this long period of positive real rates like we had in the 80s and the 90s, for example, I think that's not going to happen. And the problem is that interest rates are, I think, going to be increasingly politicized. Right. So now that the Fed is unprofitable, now that small and medium-sized banks are pressured, um, we saw, for example, in Congress the other day. I mean, Elizabeth Warren was questioning Jerome Powell and basically saying, like, what are you going to say to the 2 million Americans that you're projecting you're going to put under work with your rate hikes? Basically, in these types of financial pressure scenarios, um, interest rates become very politicized. So if you look back in the 70s and 80s, Jimmy Carter put Volcker in. Um, and that arguably that hurt his reelection chances, but he viewed it as an important thing to do for stability. And then Reagan also let Volcker continue doing what he was doing. And so for a long stretch of presidents, both Democratic and Republican, you had a high degree of independence where they didn't really kind of question central bank decisions as much. Whereas you started seeing under Trump, he was not happy with Jerome Powell raising rates. And now you're seeing it from, even though Biden hasn't really gone that route, you've seen it among, Democrats in Congress where they've questioned um, Jerome Powell's roots. And so I think a challenge is that both over the next year and longer term, monetary policy in many ways becomes politicized. The Fed essentially becomes the fourth branch of governments. And so it's hard to predict all out. But I think the baseline assumption or the baseline math, the way that it kind of works out, is that rates are going to spend most of their time submerged below inflation, with perhaps brief exceptions during disinflationary shocks.